Mike and Tom are registered with Steward Partners Global Advisors. Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom.
Hello everybody, welcome back to another edition of Common Sense Finance. This is Tom Farrell, I'm Mike Wiginton. And today I suppose we're going to talk about something that must have woken you up in the night. Maybe you're not sleeping well, maybe it could be those oversized glasses that you've been wearing lately. But something was bothering you and you decided that you wanted to talk about risk-adjusted returns. A subject that I love, by the way. But if I brought this up, you'd have shot it down. No question about it. But look, I'm totally comfortable with that. And so I'll set this up for what do you say? I'll set the pitch up for you.
Okay.
We see it all the time. All the time. We have people will come usually after the fact, after they've already signed some sort of document committing to something. Then they ask the question. They ask the questions. Folks getting involved in investments. Lots of times, not all the time, but lots of times it has to do with real estate, okay? And the question becomes, what is your expected return? And if we were going to get technical with them, we say, what's your expected risk-adjusted return on that? And it boils down to this. The riskier the venture, which has to do with uncertain profits, okay? Profits, aka returns, the higher the return that you should make. Okay? Yep. I don't expect a return from as much of a return from a T-bill where my return is guaranteed. I know when I make it exactly what I'm going to make.
Right.
Okay? You take lower returns for that. The higher the risk level, the uncertainty, you got to get paid for it. And people don't look at it that way. They don't think about it that way. Don't know how to judge it. That's a problem. Take it away.
Yeah, and I'm thinking about this along the lines of investors in the financial markets, and risk is deviation from an expected outcome. So, and to measure investment risk, there's a lot of tools: alpha, beta, standard deviation, all that stuff. We won't go into detail on that, but an example of what we're talking about here is say you have two companies, and we may have touched on this before, but you have two companies. One, company A is a company that's been around for a long time. They have a very strong balance sheet. They have somewhat predictable revenue flows, so they're stable. You kind of know what you're getting with them, and your expected rate of return is going to be, and again for an example, is going to be say 10% a year on that. Pretty close in line with the market. And on the downside, you can expect to possibly have a 10% pullback in that stock. Versus company B, which is, say, a startup, a young company, maybe some kind of biotech company or some kind of technology company that maybe they have a great idea, some great innovations that they think are coming, but they haven't made a lot of money yet. They're not cash flow positive. They have a lot of debt. You would expect your rate of return on a company like that to be much greater than from the previous company I was talking about. So let's say you invested in both of these companies, and over the course of several years, you had the exact same return for each one of them. They were both up the exact same amount. I would say to you, you made a huge mistake if we're playing Monday morning quarterback by investing in company B.
Well, financially speaking, that would be exactly the answer. It wouldn't be your opinion.
Right.
Okay.
But it's always easy to look back. So the reason I bring this up is we have, we talk to people all the time that say, well, my account was down, and they may be at, another firm, and we're talking to them. They say, well, I lost X amount of money last year, and I'm unhappy with what my advisor has done, and a lot of times, maybe the few years before that their account was up tremendously, but they don't think about and I know you've talked about this, people are loss averse as opposed to risk averse, but maybe they don't think about how they're invested when things are going well, but they really, they find out, and again, the ticking time bomb is, maybe you're taking on more risk than you should to get the return that you need. So,
listen, if there are, and we won't even say one, if there are 2, 3 diseases amongst people that invest in the stock market, this is one of the top major diseases. All right, and this is a paradigm or a cognition disease. And I'll go you one better, because that's a great example you use, and hopefully people can see the small biotech firm from some stable, long, mature company that's predictable, and that, I think that paints the picture really well. But I'll tell you that you get into these companies that are making money. They're not startups. They're well along the lines. They could be a major electric vehicle manufacturer.
Right.
They could be a major semiconductor chip manufacturer that's going to control AI. They could be any number of these well-known, very popular technology-related stocks. And when you look at valuation, so they're making money.
Right.
It's not a question of whether it's a good company, a profitable company. It's a matter of what is the valuation. And you're taking a position expecting things to go on in the future in terms of price appreciation, just like they have in the past, without any regard to what is the valuation. Mm-hmm. And so when I know something's trading for 200 times earnings, 68 times earnings, that's 68 years worth of earnings. You may have purchased it when it was trading at 17 years worth of earnings.
Right.
Those are two totally different risk profiles.
Yep.
Two totally, and when a stock moves down $40 in a day, $80 in a day, all right? Not all stocks do that, by the way. All right? And so, but you're getting into, and they are errors in thinking. And so they have no idea the client has no idea what sort of risk level that they're taking on.
Yeah.
And so,
and that's the thing too, is when the market's doing well and everything's kind of going up, and their account, people don't realize that the ticking time bomb thing is, well, your portfolio's done well, great, it's gone up, but
what's the risk you're going to take a round trip?
That's right.
I think the ticking time bomb's a beautiful title for that.
So if you're really, and it takes some, and you know this, it takes some a lot of question and answer session, brainstorming when you're talking to somebody to figure out, okay, where do they line up as far as their investment profile and all that, and sometimes it's trial and error a little bit, but you really want to try to dial that in, because nobody is going to say, hey, you're taking too much risk when the market's going up every day. But at some point, that trend will reverse, and if are you going to be able to be comfortable and to absorb whatever downswing that we're going to have coming,
when the market behaves like the market behaves.
Yes. And so if you are over-risked versus your investment profile, then you're going to be very uncomfortable to the point of, hey, I'm going to do something irrational when that happens. If you are more lined up with your investment profile, your risk-adjusted return should, in most cases, you're going to be comfortable, you're going to be able to live with what may come down the road.
Another subject matter for another podcast or another day, but the whole investment profile or risk profile, I think there's so much baloney in that too. It's like these surveys, and statistics have proven so many of these surveys are irrelevant because of the questions they're asking,
Oh, yeah,
how they can be
it's-
gamed, and so anyway.
Right.
Yeah,
Anyway,
and I think that's good.
that's all I have to say.
That's
on
all you have to say
That's
on that?
it. Yep.
All right. We'll see you next time.
Controversy. You get high. Does your daddy cry? Controversy. 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 Do I believe God? Or do I believe me? Some people wanna die so they can be free. So life is just a game. We're all just the same. Controversy. Controversy. Controversy.